Hey folks, in this video I'm going to talk about cap rate. I'm going to describe what it is, but I'm also going to walk you through calculating it using my calculator. I hope you like it. Thanks. I'm Joe DeSanto, by the way. I am an independent CFO and business consultant. I actually spent the first 20 years of my career in Los Angeles building several multi-million-dollar businesses in the advertising and entertainment space. And I have since semi-retired, and I'm working part-time doing CFO work and business management work for small businesses and high-income individuals. But I also have my website, Play Louder, and there you can find all sorts of great information on personal finance, small business, and real estate investing. So if you are interested in expanding your income potential and also keeping more of that money so it can grow and get you to the promised land, as I like to call it, a little sooner, please go check it out. I think you will find it helpful. Thanks. Oh, and don't forget to subscribe. I'm going to be releasing a bunch more videos on personal finance, small business, and real estate investing. The 3 pillars to success, as I like to call them. So if you're looking to increase your income and keep more of the money that you're making so you can invest it and grow it more quickly for the future, I think the channel will be very helpful for you. Thanks. Hi all. Thanks for checking out my video here about my cap rate calculator. So, a couple things to start. First, I want to say this cap rate calculator. I like it. Obviously, I made it, but it is kind of a derivative of a larger, more robust calculator that calculates like total return on real estate investments, and that's this thing. And it's also available in the free course that you downloaded, and probably, the cap rate calculator would lead you to this because, cap rate's a limited metric, whereas total return on real estate, or internal rate of return as it's often called, is, in my opinion, the most important thing because it shows you the grand total compound annual growth rate percentage for your invested capital, and that's what you can compare against something like the stock market or other investments. But cap rate is kind of, a quicker metric, I guess a more limited but quicker metric that's very commonly used to establish the quality of an investment. And truth be told, like, I learned cap rate just in my own, comings and goings of investing in real estate. I've done mostly residential, but I've bought and renovated 2 commercial buildings. And I found the metric of cap rate to be used more in the commercial world, okay? Not to say it's not used in the residential world, but I feel like a sort of similar metric that's much more commonly used in residential is cash on cash return. And while they're similar-ish, they're not the same thing. And I actually put this cash on cash return as part of my calculator, just to so you can see the comparison. Sorry, I'm gonna adjust this here so you can see the whole calculator. But let me. I'm going to talk a little bit about all of it. But let me start with cap rate. So, confession, I guess you might say. As I was saying, when I learned cap rate, it was really through just the industry and real estate professionals I was working with, and I kind of learned cap rate in this way. Like, cap rate essentially is the percentage of return on invested monies, or percentage of return on the purchase price of a piece of real estate, right? So, and I should say, cap rate is always calculated assuming there's no loan. So it's kind of like whatever the net operating income is of the property, so rental income less expenses, you divide that by the purchase price, and that's the cap rate. And as you can see here in the calculator, I have the formula for the cap rate percentage here. Then I have a secondary formula where you're kind of formulating purchase price, and I'll explain that in a sec. But in my basic setup here, I have this say single family house costs $100,000. There's no loan, as I mentioned. The rental income, say at $1,000 a month, is $12,000 a year, less annual expenses. So the net operating income is $5,300 a year. You divide that by the purchase price, and then you times by 100, which gives you the percentage, and your cap rate would be 5.3%. And you're like, okay, well, it's not an internal rate of return. It's not a total return on the investment. It doesn't factor in everything like appreciation, amortization, tax effects, and all that sort of stuff. But on an annual basis, for my invested cash, or the purchase price, say I was 100% in, no down, no loan, my invested cash would be getting 5.3% of my money. And that metric obviously is something that you could compare to, like, I don't know, a dividend stock or a savings account, or if you went out and did notes, and you were getting an annualized return, you can kind of use it as a point of comparison on return. And that's kind of how I sort of learned it. But truth be told, I made a video explaining that, and I kind of got called out on it on YouTube, so I'm remaking this video. And what I was told, and it's actually not incorrect, is that cap rate was really more intended to help you evaluate what a proper purchase price would be for a property. Now, the factors that go into the formula in both cases are the same. The cap rate is the cap rate, NOI is NOI, property price. But if you were looking at a property and you were going to say to yourself, well, I know how much rental income it has, okay? So I want to know, based on average cap rates that I could calculate on other previous recent sales, right? If I could go out there and gather that information, which I could, one way or another, I'd have an average cap rate for that area. Well, if I know how much net operating income there is, and I know the average cap rate for the area, I know a purchase price that would be worth paying for that property. So I guess what I've been told, the initial kind of or real intention of cap rate is to assess value of a property, not to show you what the quality of the return is. Now that said, if you go looking on on Google and you just look up cap rate definition, most people talk about cap rate as a metric that shows you rate of return on your money. So, but really, I think you kind of use them in tandem, and you can use them both. And it's kind of more about, like, what's the question that's being asked. Usually, if you're a buyer, you're looking at a property. You know the purchase price because there's always an asking price already for the property. And then you figure out what the rental income would be and any expenses, and you get the net operating income, and you can say, hey, well, this property I'm looking at, they're selling it at a 5 cap or a 5, let's say 5.3 cap, so it matches up with my default bits of my calculator here. And so then you're saying to yourself, well, do I want to buy it at a 5.3 cap? Maybe you want more return. Well, of course you want more return. So you're thinking, well, maybe I'd buy it at a 6 cap. Well, what would I have to offer, in order to buy this thing at a 6 cap? Now, a common question as a seller is, all right, I'm selling my property. What should I list it for? And you may or may not know well, you probably would know, like, what some general cap rate things have sold for in the past, but usually you're saying to yourself, well, can I get away with a lower cap rate for my sale because, you want to make as much money on your property as possible. So you're usually saying, well, I know the average cap rate in town is a 6. Can I sell my property so let's say a 5.3 cap rate, just to match up with my calculator? What would that purchase price be? Those are the two most common scenarios or questions, I've come across. You might be saying to yourself, well, Joe, what you just described really was you trying to assess the value, either as a seller or a buyer. And that is true, so maybe that proves the point. But at the same time, I'm making that, I'm trying to figure that out based on a like desired return more so than using the cap rate of other recently sold properties as a way to establish value. I'm more focused on as a buyer, well, I want to get more return on my money, so I have to pay less. And as the seller, you're like, well, I want to sell my property for more, so how much do I think the market's willing to bear in terms of a more limited return on their invested capital. But that said, I'm an individual investor. I've transacted on about 16 properties, including my residences, which I consider investments. So I'm not an institutional real estate investor. I don't do it for a living. So maybe if you're doing it for a living, working at a firm, doing deals all the time, maybe you really are using it strictly as an assessment of value. I don't know. Also, in some sense, it's an assessment of risk. Often the idea would be that if in the area you're buying, if stuff is trading at a lower cap rate, meaning people are willing to pay more for less income, well, then that income is probably more stable, meaning your invested capital is at less risk. If that a cap rate in a certain area is much higher, meaning people they really want a lot of potential return for their capital, well, maybe that capital is at more risk. Just like in the corporate bond market. If you're buying corporate bonds of a very highly rated company, you're going to get less return on your capital. If you're going to go with the junk bonds, you're going to get more return on your capital, right? Because they're riskier. So people, I think, also kind of use it in that sense. But all that said, as I've written up here, cap rate percentage is net operating income divided by property price times 100. The times 100 is the percent part of the cap rate. But if you wanted to look at property price based on cap rate, you would have net operating income divided by cap rate percentage times 100. And that's what I have here in these two calculators. Now, obviously, as I mentioned before, I have cash on cash. The reason I have that is because, as I've said, it's a more common metric in residential, and it seems like it would be similar, but it's really not, because usually in residential, when you're doing cash on cash return calculation, you're always often going to have a loan, have some leverage on the property, so you got to factor that in. And whatnot. But I'll talk a little bit more about that in a second. So anyway, just to go through the calculators, up here, the calculation is being made off of these two numbers here, and these two numbers basically are gathering data from the full calculator, or the full set of data. So with the cap rate, when calculating cap rate, we know the purchase price. We know we're 100% down or no loan. So these two boxes aren't mattering. We put in our monthly revenue, which calculates up to gross annual revenue, and then we have our expenses here. That gives us our net operating income. As you can see, it's total gross revenue minus total annual expense. Purchase price comes from here. You make the calculation, it's 5.3%. In reverse, I guess you might say, we know the cap rate. Say we know the cap rate, say we've done that research and we know other properties in the area, the average cap rate stuff is trading at is 5.3%, and we know that our income is $12,000. We know our annual expense is $600-700, or obviously you're making an estimation, but that's your estimation. Well, the calculation is net operating income divided by cap rate percentage times 100, and you can see they're just inversely correlated there. So that's what these calculators are doing. Now, where they're kind of handy is, back to those questions, the buyer or the seller is asking themselves. I think normally you would say, what the purchase price is, you have your estimation on net operating income, so you're like, hey, I'm looking at this property and they're trying to sell it at a 5.3 cap. Well, I want a 6 cap, right? So what should I go offer them? Well, if you come over here and you put in 6%, the calculator says, well, you should be paying $88,000 for it. That's what you got to pay to get a 6 cap, you know? Conversely, if you're the seller and you're saying, well, I know all the properties in my area are selling at a 5.3 cap on average, but I want to see if I can sell at a 4.5 cap because that would yield me a higher purchase price. What would my purchase price be? I mean, my sale price be? Well, you would then go try to list your place at 117,000 or 118,000 if you're rounding up. So this calculator is kind of handy in that sense. Now, to get to the cash-on-cash comparison, just because, like I was saying, I feel like they're sort of correlated, or they're sort of similar, not correlated. But I want to show the difference of the common understanding of cash-on-cash. Now, cash-on-cash, as I said, is used more in residential, and it's generally assumed you're going to have a loan, you know, when you're kind of factoring a cash-on-cash. But the reason I say they're similar is because with cap rate, it's assumed the calculation is based on no loan, just like whatever the purchase price is. But if you were to go buy something truly with no loan, well, you would sort of, be similarly getting a cash-on-cash return based on, nothing, based on 100% down. But let's just say, your average rental property, you're going to put 25% down. So say your property is looking at as $100,000. You know the income, or you have your estimated income, estimated expense, right? But you're going to put 25% down, so you're not going to go 100% cash. And also, at least when I calculate cash on cash, I'm really calculating cash on full cash invested. So that'd be down payment plus closing costs, right? So in this case, with these numbers, that's a total of $20,500. When I calculate the cash on cash there, I'm looking at annual cash flow, okay, divided by invested capital would get you cash on cash. And because here the annual cash flow is much lower than you see over here, it's because, well, I have a loan, right? I have these loan metrics in here at 5% 30-year loan. Now you can change these, and you can change other annual expenses. And the reason I do that is because I like to make calculators where you can just be like, well, what would happen if? What would happen if? So what if I could get a loan that was 3.5% at 30 years? How would that change my cash-on-cash return? Wow, makes a big difference. My cash-on-cash now goes up to 4.3%. What if I managed it myself? Wow, big difference. Cash-on-cash goes up to 8.5%. What if I had no vacancy and turnover because I had a good tenant and they stayed for 3 years, 4 years? Wow, cash on cash goes up pretty high. So, and you can make those changes over here as well. But like I said, in residential, you're normally using this one. Now, I feel like part of the reason cap rate's more common in commercial is that a common way to rent in commercial is what's called a triple net lease. So, and it's actually pretty great. Wish it existed in residential. But in a triple net lease, you as the owner, you rent your building out, whatever square footage price per month, and the tenant is responsible for all repairs and expenses, all insurance, and all taxes. So when you're renting out your building triple net, like whatever your rent is, that's it. You know your income. There are no variable expenses because all the variables are going to be picked up by the tenant. And that's one of the things that makes me feel like it's more common in commercial, because like, how would you go out and get that cap rate data? Like, how would you go out and get, like, you can get the purchase prices, you can get pretty easily, and you can get probably what the rental rate is, but if they were actually having to like calculate in all the expenses and stuff to get a cap rate, well, that'd be harder to get because then you'd have to get in the books of the owner of the building. So I feel like that's kind of why cap rates used more in commercial, in cash on cash is probably used more in residential, but that's just a guess. But anyway, these metrics are valuable any way you slice them. And these are my handy calculators to kind of figure them out. And again, my calculators, I designed them for myself. I mean, I'm just sharing all these things I've made for myself, but I try to make calculators where I can easily change the scenarios and do the what if scenarios. Um, so hopefully it's helpful for you, and I will repeat myself yet again. If you like this one, you're probably in the free course anyway. You're gonna run into this one, and this is the one that really is, the heart of the matter, I guess, in my opinion, as far as real estate investing returns. I mean, this is, the holy grail because it factors in absolutely everything and gives you like a true total compound annual growth rate, and it also gives you what that compound annual growth rate would be if you got out of the investment in any given year in a 30-year period, which is important. So anyway, let me know if you have any questions, and thanks for checking it out. See ya.